Around the kitchen tables of America right now, it is June 2026. There is a check arriving every month that millions of seniors are about to misread. The letter from the Social Security Administration said the word raise. It said 2.8%. It said your new benefit is $56 higher than before. And for a lot of folks, that was the last time they looked at the letter. They slid it into a drawer. They thanked the government. They went on with their month. That is a mistake, and it is a mistake the government is hoping you will make. Because the same letter, the same one-page notice the SSA sent out in December of 2025 quietly says that the Medicare premium they pull out of your check has gone up to $202.90, not $185. That single line at the bottom, the one most seniors do not circle, takes back almost $18 a month. That means the raise you were promised in January was not really 2.8% when it landed in your wallet. It was closer to 2%. And if your prescription plan costs went up, and most of them did, your real raise could quietly turn into a pay cut. This is the part nobody is explaining on the nightly news. This is the part most financial advisors on television will skip because they love talking in percentages and they do not like talking about gallons of gas and bags of groceries. So today, we are going to sit down at the table together. We are going to walk through exactly what changed in 2026, exactly where the money is going, and exactly what 3 moves you can still make before the end of this year to keep every dollar you have already earned. I spend my days tracking these numbers because the SSA does not have a team dialing your phone to walk you through the math. They only call when they want money back. The only way to stay ahead of changes like this is to be plugged into the channel. Make sure that subscribe button is pressed and the bell is on because the letters keep coming and the windows keep closing. Let's start with the number on top of the letter because that is the bait. The 2.8% cost of living adjustment for 2026 is real, and it is in your check, and you should be glad to have it. The Social Security Administration announced on October 24th of last year that benefits would rise 2.8% starting in January of 2026, the same way they have for decades. The average retired worker is now collecting about $2,071 a month, up from $2,015. That is the official story. That is the headline. And the headline is not a lie. It is just incomplete. Here's what the headline leaves out. On November 14th of last year, the Centers for Medicare and Medicaid Services announced the new 2026 premium for Medicare Part B. Part B is the part that covers your doctor visits and your outpatient care. It is the part the government pulls out of your Social Security check before you ever see a dollar. In 2026, that premium jumped from $185 a month all the way to $202.90. That is a 9.7% increase in a single year. It is the largest Part B premium hike in more than a decade. And for the average retired worker, it canceled out almost a third of the COLA raise in the very first month. Let me put that in plain dollars, the way we would talk about it across the table. If you were getting $2,015 a month in December and your January check was supposed to be $2,071 because of the COLA, the actual number that hit your bank account probably looked like $2,053.10. The government took back $17.90 to pay for that Medicare Part B premium increase. That $18 is not a small number. That is a full tank of gas in much of the country. That is 2 weeks of your over-the-counter medicines at the pharmacy. That is the copay on 3 or 4 of your regular prescriptions. That is the difference between buying the brand of coffee you have bought for 30 years and switching to the off-brand because the off-brand is what fits the new math. Now let me give you the 3 real-life examples because I want you to see yourself in one of them. Example 1, a 72-year-old widow in Ohio living on the average retired worker benefit. In 2025, she was getting $2,015. In 2026, her benefit letter told her she had a raise to $2,071. She told her daughter on the phone she was finally getting ahead. But after the new $202.90 Part B premium was taken out, she actually had $2,053.10 to spend. Her net raise after the deduction was $38.10 a month, not $56. That gap of almost $18 is real and it is in her pocket right now, even if the letter told her otherwise. Example 2, a 68-year-old retired letter carrier in Texas whose Part B premium is being paid through a state-level subsidy that quietly ended in 2026. He now pays the full $202.90, where last year he paid $128 a month thanks to the subsidy. His COLA went up $56. His out-of-pocket Medicare cost went up $75. He is $20 a month behind where he was on December 31st. Example 3, a 63-year-old disability recipient in Pennsylvania who is on Medicare and whose supplemental insurance premium also went up by roughly $25 a month in 2026. Her COLA was $39. Her premium pile went up by $43. She is $4 a month worse off than before the raise, on a benefit that was already small. This is what is called the COLA illusion. And I want to be honest about it, there is a sector of the financial industry that benefits from you not noticing it. The financial talking heads on television love to talk about the gross number, the 2.8%, the headline raise. It makes the channel look informed, and it makes the sponsor look generous. But the gross number is not what lands in your hand. The net number is what buys groceries, and the net number for millions of seniors in 2026 is smaller than the letter made it sound. Before we move on to the good news, and there is good news, and I mean to get to every piece of it, I want to make sure we do not lose sight of one thing. This channel exists for one reason. The Social Security Administration sends out one letter a year. The letter tells you the gross number. The letter does not walk you through the net number. The letter does not explain that your Medicare premium went up almost 10%. The letter does not remind you to check your My Social Security account and confirm the exact figure that hits your bank account. I track these codes because nobody else is going to call you and walk you through them. They only call when they want money back. Hit that subscribe button and turn on the bell, because once this letter is filed in the drawer, the train has already left the station for the rest of the year. Now we are going to look at the second big story of 2026, and this one most people have not heard at all. It is not bad news, but it is news with a catch. And the catch is the kind of thing that should make any senior with a fixed income sit up straight. Last summer, Congress passed a piece of legislation nicknamed the One Big Beautiful Bill. Hidden inside it, in the tax section, was a brand new deduction for Americans age 65 and older. In tax year 2025, which you will file in 2026, and again in tax year 2026, which you will file in 2027, you can deduct up to $6,000 from your taxable income simply for being 65 or older, if your modified adjusted gross income is $75,000 or less as a single filer, or $150,000 or less as a married couple filing jointly, you get the full $6,000. Above those numbers, it phases out. The deduction ends after the 2028 tax year unless Congress extends it. This is real money, and I want to walk through exactly how it lands. Take a retired couple in Florida, both age 68, both collecting Social Security, with about $48,000 a year in total benefits and a small pension. Before the new law, they paid federal income tax on up to 85% of their Social Security because their combined income was high enough. After the new $6,000 deduction on top of the standard deduction, their taxable income drops enough that a meaningful slice of their Social Security becomes tax-free. The AARP estimates that for about a third of seniors who currently pay tax on their benefits, the new deduction wipes out that tax bill entirely. That is not a small thing. For a couple in the 15% federal bracket, eliminating tax on $10,000 of benefits is worth about $1,500 a year in their pocket. That is real. That is the new law in plain English. But here is the catch, and I want you to hear it clearly. The chief actuary of the Social Security Administration published an analysis on August 5th of last year. In that analysis, he warned Congress that the new $6,000 senior deduction will cost the Social Security trust funds about $168.6 billion in lost tax revenue over the next 10 years. Federal income taxes on Social Security benefits flow directly into the Retirement and Survivor Trust Fund. Lose that revenue, and the fund runs out of money faster. Without this deduction, the Retirement and Survivor Fund was projected to run short in the first quarter of 2033. With the deduction, the chief actuary says the fund runs short in the fourth quarter of 2032, 6 months. That is how much closer the program came to running out of money, because Congress decided to give seniors a tax break. For you sitting at the table, this matters for one reason. The closer that depletion date gets, the louder the conversations in Washington will become about cutting benefits, raising the retirement age, or taxing higher earners into the program. The six-figure limit, a real proposal now being floated by budget groups in Washington, would cap a couple's combined Social Security at $100,000 a year and a single person's at $50,000. It is not law. It is not even close to law. But proposals like it move from think tanks to congressional hearings one step at a time, and they almost always accelerate after the trust fund date moves closer. So the very deduction that puts money in your pocket in 2026 is the same deduction that brings the day of reckoning a half year nearer for your children, and for you if you live long enough to collect into your late 80s and beyond. That is the trade, and you deserve to know both sides. The third number that changed in 2026 is the one that bites working seniors the hardest, and I want to slow down on this because the SSA does almost no public education about it. It is called the Retirement Earnings Test, and if you are collecting Social Security before your full retirement age and you are still earning a paycheck, this rule can quietly take thousands of dollars out of your check without warning. Before we go deeper, I want to flag something. The full retirement age for anyone born in 1960 or later is now 67. If you are 62 right now, you are looking at 5 more years before the earnings test goes away for good. That is why this rule matters more in 2026 than it did a decade ago. As of January 1st, the earnings test exempt amount for seniors who have not yet reached full retirement age went from $23,400 a year to $24,480. The year you reach full retirement age, the exempt amount jumped from $62,160 to $65,160. These are the limits. Above these limits, the SSA pulls dollars out of your benefit. Here's how it works with real numbers. Suppose you are 64 years old. You started collecting Social Security early because you needed the money. You are still working part-time as a consultant, and in 2026, you earn $40,000. The exempt amount for you is $24,480. The amount over the limit is $15,520. The SSA withholds $1 of your benefit for every $2 over the limit. That is $7,760. $7,760. That is not a typo. That is the rule. That money is not lost forever. Once you hit full retirement age, the SSA recalculates your benefit and gives you more each month going forward to make up for what was withheld. But in the meantime, in the year you actually need that money, it is gone. It is the easiest senior tax in America to fall into because most working retirees never see the warning letter until their check arrives $640 short one month. The fourth number that matters in 2026 is one that quietly increased and that almost nobody covered in the press. The taxable maximum, SAO, the cap on earnings that get hit with the Social Security payroll tax, went up from $176,100 to $184,500. The tax rate did not change. It is still 6.2% from your paycheck and 6.2% from your employer, for a combined 12.4%. But the wage base went up by $8,400. If you are still working, that means $521 more of your 2026 income goes into the Social Security system than in 2025. This is not a senior-specific change in the sense that it changes your benefit, but it is a reminder that the program's solvency math is moving, and when the cap moves up by 4.8% in a year when wages only grew about 3%, somebody in Washington is trying to widen the funding river a little faster. That is a fact worth keeping in the back of your mind. And the last 2026 number I want to walk you through, slowly, is one that matters to a smaller but very vulnerable group. The Supplemental Security Income Program, SSIE, is the federal safety net for low-income seniors, disabled adults, and certain children. The federal payment standard went up from $967 a month for an individual to $994. For a couple, it went from $1,450 to $1,491. Notice the lift. It is real, but it is small. $27 a month for an individual, $41 for a couple. And the resource limits, the amount of money you are allowed to have in the bank and still qualify, did not change at all. They are still $2,000 for an individual and $3,000 for a couple. That has not moved in decades. So, if you are on SSI, your COLA went up by $27, your housing cost probably went up by more than $27, and you are still one car repair or one funeral away from losing your eligibility the moment your bank balance crosses the line. Watch your bank balance. That is not a financial tip. It is a survival rule for 2026. Now for the part of the video I promised you at the start, the good news, the legal protections, the moves that real seniors are making right now in 2026 to keep more of what they earned. Move 1. Read your COLA letter again. Open the envelope you put in the drawer in December. Look at the second page, not the first. The first page tells you the gross raise. The second page, or the small print near the bottom of the one-page notice, tells you the exact dollar amount of every deduction that comes out before the check reaches you. Medicare Part B premium, Medicare Part D premium if you have one, any overpayment recovery from a prior year, and any tax withholding you voluntarily set up. Add those up. That is the net raise. If your net raise is less than $30 a month, you are in the COLA illusion group. You have a decision to make about your supplemental insurance and your prescription plan, and we will get to that. Move 2. Check your eligibility for the new $6,000 senior deduction before you file your 2025 taxes. The deduction is real, and the IRS guidance for tax year 2025 was published last fall. If your modified adjusted gross income is below $75,000 single or $150,000 joint, you qualify for the full $6,000 deduction on top of your standard deduction. That can drop the taxable portion of your Social Security to zero or close to it. If you use a tax preparer, ask them by name. Did you apply the new additional standard deduction for age 65 and older from the One Big Beautiful Bill? Do not let them nod and move on. Make them show you the line. Move 3. If you are still working and collecting Social Security before full retirement age, plan your 2026 work income to stay under $24,480. That is the limit. Every $2 over the limit costs you $1 in withheld benefits. If your business income is unpredictable, defer what you can into the following calendar year. If your only income is a part-time job, ask your employer to hold back overtime in months that would push you over the line. The rule is not generous. The rule is mechanical, but you can drive around it if you plan ahead. Move 4. Coordinate your claiming with your spouse. If you are a married couple and one of you earned significantly more over a career than the other, the higher earner should usually delay until 70, and the lower earner should often claim at 62 or at full retirement age. The spousal benefit math in 2026, with the higher full retirement age and the higher wage base, rewards the couple that coordinates and punishes the couple that both claims at 62 and hopes for the best. Run the numbers with a calculator, not with a feeling. Move 5. If you are on Medicare, shop your Part D prescription plan every single October. The COLA letter that arrived in December did not change your prescription drug plan. Your prescription drug plan premium likely went up on January 1st, all on its own. Open your mailbox in October when the annual notice of change arrives. Compare your drug list across the plans offered in your county. A 45-minute review in October can save you $400 to $1,200 over the course of the calendar year, and it is the single highest return piece of paperwork you will touch all year. I spend my days tracking these codes because the Social Security Administration does not pick up the phone to walk you through any of them. The only way to get the full picture is to be plugged into a community that reads the same fine print you do and warns you when something shifts. Subscribe to this channel and turn on the bell, because the 2027 COLA letter is already being calculated, and I intend to read it line by line the moment it lands. Knowledge is your only shield in retirement. Do not let them catch you off guard. I'll see you in the next one.